So guys, we have 4 different WealthMore portfolios. We have our conservative growth, balanced growth, moderate growth, and our aggressive growth portfolios. We certainly try to manage costs there by using a lot of low cost ETFs, but the sort of genius behind our portfolio strategy, I'll let Matthew sort of give you guys a little bit of context around how we approach the 4 different portfolios.
Sure, yeah. The conservative portfolio we put together for those who don't have the stomach for stock market returns. Because, as much as I like to have risk and things like that, there's people out there that just either A, can't take on the risk because of their situation, or B, just don't want to. Just frankly would
Yeah,
never want to see their money lose money, or if it does, they can only really handle a little. So that's what
yeah,
this portfolio, it's mostly fixed income, 100% fixed income. It's looking to hedge, not hedge, but have inflation protected returns, things
yeah,
like that. So just to make sure that you're at least growing your money a little bit over
yeah,
the cost of inflation so that you're making real dollars. The next portfolio on the kind of risk scale is the balanced growth portfolio.
yeah,
So for this portfolio, we have about 60% fixed income. So it's still pretty conservative for those who don't want to take on too much risk. For the equity portion, we're not in all US stocks. We're about half of the 40% invested in stocks. We're about half and half international and US stocks, as well as a small allocation to some commodities, just to, again, build that diversification into the
yeah,
portfolios. The moderate portfolio, same thing. We're kind of moving along the risk line.
yeah,
So this one has a bit more in equities. It's got about 60 to 70% equities and kind of 30% fixed income. Again, same thing, but we want US and non-US stocks. We want some alternative kind of investments like gold or commodities just to kind of balance it out. And then, yeah, the fixed income is there to kind of offset some of the risk. So if the market goes down 20%, we're kind of hoping the portfolio goes down half of that to take on about half the risk of the stock market.